Hey, welcome everyone. I'm Ted Erhart. I just want to follow up on a video I did in recent weeks talking about the housing market. I think I titled that something to the effect of 3 reasons why the housing market is unlikely to bust. Well, there's a good article today on CNBC's page that really provides some good stats that characterize the strength of the housing market financially. And I just want to emphasize here, we've seen a huge move in long-term interest rates this year, and mortgage rates have therefore followed. And in fact, mortgage rates have basically doubled over the last year. So we're starting to see some signs that the housing market is cooling. But basically what I'm articulating here is, we certainly could see housing prices pull back modestly, but the chances of a meltdown like we saw roughly a dozen 12, 13, 14 years ago, I think is extraordinarily unlikely. And this article really paints a great picture as to why I hold that view. So here's the article. I'll make sure I put the link in the description. You can check it out for yourself. But I just wanted to highlight a couple things here. Specifically, take a look at some of these figures. So total mortgage debt right now in the United States is less than 43% of current home values, which is the lowest on record. So that means the housing market in the U.S. In total has a 43% leverage ratio. In other words, a $100,000 home on average has only $43,000 of mortgage debt against it. That's what a 43% leverage ratio means. So if you only owe $43,000 on a $100,000 property, you have a tremendous amount of equity, obviously. And that was the total opposite situation back in the housing bust. In fact, according to this data, apparently all this data is coming from this firm called Black Knight, so take that for what it's worth. I don't know much about Black Knight, but we'll take them at their word. So back when home prices were kind of near the trough, 1 in 4 homeowners in the U.S. had negative equity. And right now, only 2.5% of homeowners in the United States have less than 10% equity. So think about that. 25% of the housing market had negative equity at the trough of the housing market. Today, that's sitting at only 2.5%. And furthermore, the last thing I'll just point out in this thing, so there's currently 2.5 million adjustable rate mortgages, or those what kind of became infamous, if you will. We had all these adjustable rate mortgages. Well, adjustable rate mortgages collectively only represent 8% of total outstanding active mortgages. Let's go back to 2007, kind of at the peak of the last economic cycle, right in front of the housing meltdown. Look at this, over a third of mortgages at that point in time were adjustable rate, and in many cases, of course, those were underwritten to people who really had no chance in hell in ever paying those back. So look, long story short here, the housing market today is in a very strong position. Obviously, a lot of that was driven with these rock bottom mortgage rates, and with rates rising, again, we certainly could see some moderation. We could see housing prices dip slightly, but in my view, there's virtually, I don't want to say no chance, but there's an exceptionally small chance that we see a pullback of the magnitude that we saw following the global financial crisis. So this just caught my attention today. That'd be something kind of light and interesting to throw out on a Monday. Thanks for watching as always. We'll see you in the next one.